Buying your first house sounds exciting, but can also be an overwhelming experience for many. You see, there are a lot of decisions to make, not just choosing the house itself, but how you're going to pay for it. But don't worry, I'm here to make your home buying journey a breeze. In today's video, I'll be breaking down the two most common loan programs for first-timers and which one suits you best. Now, before we talk about choosing the best loan program for your needs, don't forget to subscribe and hit that bell to turn on notifications. A home is usually the largest single investment you'll make, and most people use FHA loans or conventional loans to finance this. But which program offers the best rates, the best terms, and the most flexible qualification requirements? Hi, I'm Tommy, and I've been in the real estate industry for 17 years now, and I've helped many home buyers secure their dream homes using these same loans in the past. So let's get into the breakdown. Let's first start with FHA loans. FHA stands for Federal Housing Administration, which is a part of the U.S. Department of Housing and Urban Development. It's primarily known for insuring residential mortgages, which helps to reduce the risk for lenders, making homeownership more accessible for buyers and especially for first-time home buyers. One of the standout features of FHA loans is their more lenient credit score requirements. See, while traditional loans might demand a credit score of 620 or higher, FHA loans often accept scores as low as 580. This opens up the opportunities for individuals whose credit history might not be in tip-top shape, but who are otherwise responsible borrowers. When it comes to down payments, FHA loans are very accommodating. Typically, if your credit score is 580 or above, you can put down as little as 3.5%. If it's lower, you might still qualify for an FHA loan, but you'll probably need to put down 10%. The debt-to-income ratio, also known as DTI, is another area where FHA loans offer more flexibility. DTI is a measure of your monthly debt payments compared to your monthly gross income. Most conventional loans cap the DTI at around 43%, but FHA loans can go higher, sometimes up to 50% or more, depending on the lender's criteria. This higher ratio can make it easier for buyers with significant debt to qualify for a loan. However, it's important to consider the costs associated with FHA loans, particularly regarding mortgage insurance. FHA loans require both an upfront mortgage insurance premium, MIP, and an annual premium, which is typically higher than the private mortgage insurance, or also known as PMI, that conventional loans require. See, this insurance is a safety net for the lender, but does increase the overall cost of the loan for the borrower. While FHA loans can offer a more accessible path to home ownership with lower credit scores and down payments and a more lenient DTI ratio, they also come with an additional cost of higher mortgage insurance. It's crucial to weigh these factors carefully to determine if an FHA loan is the right choice for your financial situation. Conventional loans are a popular choice among home buyers and are not insured or guaranteed by federal government agencies like FHA loans are. Instead, they follow guidelines set by Fannie Mae and Freddie Mac, which are government-sponsored enterprises that work within the mortgage market to increase liquidity. A major advantage of conventional loans is the potential for lower effective interest rates, especially when you consider mortgage insurance. With conventional loans, borrowers who put down 20% or more can avoid mortgage insurance altogether. This can significantly lower the overall cost of the loan compared to FHA loans, where mortgage insurance is mandatory regardless of your down payment. Regarding down payments, conventional loans are quite flexible. While the standard is 20% to avoid mortgage insurance, you can start with as little as 3% down. This makes it accessible, although the lower your down payment, the higher your mortgage insurance premiums will be if you have less than 20% equity. When it comes to the debt-to-income ratio limits for conventional loans, they're typically stricter than those for FHA loans. Generally, lenders prefer a DTI below 43%. This is to ensure that borrowers are not overextending themselves financially and they can comfortably manage their existing debt along with their new mortgage payments. Mortgage insurance for conventional loans, often referred to as PMI or private mortgage insurance, is required when the down payment is less than 20% of the home's value. The cost of PMI varies based on the down payment amount and credit score, but can be canceled once the homeowner reaches 20% equity in their home. Unlike FHA mortgage insurance, which in many cases can't be canceled and remains for the life of the loan. In essence, while conventional loans require a more substantial initial financial commitment to avoid PMI and typically have stricter DTI requirements, they offer the benefit of potentially lower overall borrowing costs due to the waivable nature of the mortgage insurance. This makes them an attractive option for those who can meet the more stringent criteria. As a first-time home buyer, you've got several great loan options beyond the conventional and FHA loans to consider, each tailored to different needs and situations. One great option is the USDA loan, which is perfect for buyers looking to settle in designated rural areas. USDA loans offer the advantage of no down payment, which is a huge benefit if you're not able to save up for a large initial payment. They also typically offer lower interest rates and mortgage insurance costs. The key here is that the property must be in an eligible area according to USDA standards, and there are income limits to qualify. Another excellent choice for first-time buyers is the VA loan provided by the Department of Veteran Affairs. If you're a veteran, an active duty service member, or a member of a certain military-related associations, you might be eligible. You see, VA loans are incredible because they don't require a down payment or mortgage insurance. The VA loan is geared towards making homeownership feasible for service members and their families. Also, don't overlook local and state first-time homebuyer programs. Many states and cities, they offer programs that can help with down payments and closing costs and provide favorable loan terms. These programs often include grants or second mortgages with deferred payments and are specifically designed to make it easier for first-time buyers who might not qualify for other types of loans. Each of these loans has its unique requirements and benefits, so it's worth doing a deep dive to see which one aligns best with your situation. It's all about finding the right fit that will help you transition smoothly into homeownership. Have you considered an FHA or conventional loan for your home purchase? I want to know which one you're leaning towards and why. Drop your thoughts in the comments below. When we're talking FHA loans versus conventional loans, it's crucial to touch on property type restrictions, especially when it comes to condos. You see, FHA loans have specific requirements that a condominium project must meet before it's eligible for FHA financing. This includes aspects like the ratio of owner-occupied units, the financial health of the HOA, and certain types of commercial space that might be within the building. These restrictions can limit your options if you're eyeing a condo. On the flip side, conventional loans offer more flexibility with fewer restrictions on condo purchases. This means you might find it easier to finance a condo using a conventional loan, especially if the property doesn't meet the FHA's stricter criteria. This added flexibility can be a significant advantage when you're exploring different living spaces as a first-time homebuyer. Now, when it comes to employment history, both FHA and conventional loans, they generally like to see a stable 2-year work history. But the FHA can be particularly strict if you've had employment gaps. See, they typically require that these gaps be fully explained and reasonably short. If you've had a break in employment, FHA lenders might need proof that you've returned to work and are earning a stable income for at least 6 months following that gap. See, this scrutiny is part of their focus on ensuring that borrowers have reliable, ongoing income to manage their mortgage payments. Both FHA and conventional loans have a really cool feature. They allow gift funds to cover down payments and closing costs. This means family, friends, or even certain organizations can contribute to your upfront costs, making it easier to jump into homeownership. Just keep in mind though, right? Proper documentation of the source of these funds is very important to satisfy the loan requirements. All right, let's recap the key differences between FHA and conventional loans. First, credit score requirements. FHA loans are more forgiving, accepting lower credit scores, as low as 580 for the minimum down payment. When it comes to conventional loans, they typically require higher scores, usually around 620 or or above. Now, when it comes to down payments, FHA loans allow for a lower down payment, starting at just 3.5%. Conventional loans, they usually require a minimum of 3%, but putting down 20% can avoid paying mortgage insurance. Speaking of, FHA loans require both upfront and annual mortgage insurance, regardless of your down payment. For conventional loans, they also require mortgage insurance if you put down less than 20%, but it can be removed once you reach 20% of equity in your home. Now, don't forget, there's property restrictions. FHA has stricter requirements on the condition and type of property that can be purchased, especially when it comes to condos. Conventional loans offer more flexibility regarding property types and conditions. When it comes to employment history, both loans value a stable 2-year employment history, but FHA is stricter about employment gaps and requires thorough documentation and explanation. See, understanding these differences can help you choose the right loan based on your financial situation and homeownership goals. When it comes to choosing between FHA and conventional loans, it's all about your individual circumstances. Consider your credit score. Do you need the flexibility of FHA's lower credit requirements? Or can you leverage a higher credit score to secure better terms with a conventional loan? Also, think about your down payment amount. How much can you realistically afford up front? FHA might be the way if you're looking to put down less. Lastly, consider your desired loan terms, especially around aspects like mortgage insurance and property type. Tailoring the loan choice to fit your unique financial landscape is key to making a smart home ownership decision. If you're feeling overwhelmed with the decision and need personalized advice, click the link in the description for a one-on-one consultation. If you found this comparison helpful, give us a like and don't forget to subscribe and hit the bell for more insights that could save you thousands on your home purchase.